Asset classes have significantly repriced this year. We see three key factors driving markets in 2023: inflation, economic slowdown, and central bank response. Now, we continue to see central banks tightening financial conditions to combat inflation, which we expect to peak in 2023. But this is leading to economic slowdown, and markets will shift their focus from inflation to recession. Against this backdrop, we are remaining defensively positioned with a cautious view on riskier credit and equities, as spreads remain too tight to compensate for a higher chance of defaults, while earnings expectations remain elevated. Now, we think government bonds will play a growing role in portfolios and will offer both diversification and a higher level of income. As we progress through the year and as valuations adjust in equities and high yield, we will look for opportunities to re-engage with risk. We also see the current repricing as an opportunity to grow our income distributions. China is an economy in transition, and we think 2023 will offer more concrete opportunities. Over the next few months, the new administration and new policies will be put in place for the next 5 years. But the opportunities will be prevalent in onshore markets, where negative sentiment and weak fundamentals have resulted in very attractive valuations. We also see opportunities in certain sectors where valuations are attractive and earnings are less exposed to economic growth. One example is healthcare, which has defensive properties relative to the broader market, as its earnings are not affected by higher interest rates. But companies also have pricing power, which is a benefit in a higher inflation environment. In fixed income, we look for bond markets with positive real yields, for instance, Brazil or Korea, where central banks have acted preemptively and inflation has peaked or is heading down, while yields remain high. We believe the integration of sustainability factors across the whole investment process contributes to long-term value creation and managing risks. We go beyond exclusion and believe active engagement enhances value and increases impact. In the income portfolios, we see opportunities in renewable energy, infrastructure, and energy transition strategies. In infrastructure, our engagement has helped identify those companies with the best and most realistic approach to net zero infrastructure, with actionable targets to meet by 2030.